All right, today we're putting a household name under the microscope, Tyson Foods. We're going to use a value investor's checklist to see what story the numbers are really telling us. Let's get into it.
You know that feeling when you pull up a company's financials? It just hits you like a tidal wave. It's this giant wall of numbers, ratios, and metrics.
It's a lot. So the big question is, where do you even start? How do you sift through all that noise to figure out what's actually going on with the business?
Well, that's exactly why we use a framework. We're going to borrow a simple checklist, one inspired by legendary investors like Warren Buffett, to give us a clear path and make sense of this whole thing.
So, our whole investigation is going to boil down to three simple but really powerful questions. First, is the price right? The valuation. Second, is the business itself actually strong? We're talking quality and profitability. And third, what about the future? Is there any growth ahead? Let's kick it off with the price.
Okay, part one, is the price right? Now, to figure this out, we need to get our heads around a really critical idea in value investing. And that idea is the margin of safety. Just think of it like a safety buffer. It's the discount you get when you buy something for less than what it's actually worth. The bigger that discount, the more wiggle room you have if things don't go perfectly. So, what's Tyson's margin of safety look like right now? Whoa, it's negative. A pretty shocking negative 25%. For a value investor, that is a massive red flag right out of the gate. It means there's no buffer at all. In fact, it's the exact opposite. And here's the simple math behind that number. Our models, based on future cash flow, estimate the company's fair value is somewhere around $52 a share. But look, it's trading for over 65. The market price is way, way above its calculated intrinsic value. But wait, here's where the story gets a little more complicated. If you look at the price-to-earnings ratio based on its past profits, the stock looks wildly expensive. I mean, over 100. But if you look at what analysts expect it to earn in the future, the valuation suddenly looks, well, a lot more reasonable. This tells you the market is betting big time on a major comeback.
Which leads us perfectly into part two. A potentially good price doesn't mean much if the business itself is falling apart. So just how strong is Tyson Foods?
Well, here's a pretty big clue in the pro column. For 12 years in a row, Tyson has increased its dividend payment to shareholders. That kind of consistency, that's often the sign of a really stable, mature company that just churns out cash. This is pure, classic Warren Buffett thinking. He uses this great analogy about a bridge. You want a business built to handle way more stress than it'll ever face. That consistent dividend, that kind of looks like a strong bridge. But is it really?
And this is where things get really fascinating. If you look at the dividend based on accounting profit, it looks totally unsustainable. I mean, it says they're paying out over 300% of their earnings. But if you look at the actual cash the business is generating, the free cash flow, the dividend is covered pretty comfortably. It's a classic battle of accounting profit versus cold, hard cash.
Of course, a dividend is only truly safe if the business is profitable over the long haul. So let's zoom in on that. How good is Tyson at actually generating returns right now? And yeah, the picture here is pretty concerning. Just look at these key profitability metrics. Compared to their 5-year average, they've absolutely collapsed. Return on equity is down more than 86%. This tells us in no uncertain terms that the business is really struggling to make a profit right now. So that brings us to the final piece of the puzzle, part 3, growth. Where is this company headed? What's the real story here? And this right here is maybe the biggest contradiction of all for Tyson Foods. Over the last 5 years, sales are up. People are clearly buying more of their stuff. But profits? They're down. A lot. So the company is getting bigger, but it's becoming less profitable. Okay, let's step back and put all the clues together, because what we have are two very different, conflicting stories about this one company. So, the optimistic case, the bull case, is all about the future, right? It's a story of a company with growing sales and a safe dividend that's just waiting for its profits to recover. But the pessimistic, bear case is focused on today. It sees an overpriced stock, collapsing profits, and absolutely no margin of safety. So where does that leave us? The numbers are painting two completely different pictures. Is Tyson a struggling giant that's on the verge of a classic comeback? Or is it a company with some really deep issues where the market is just overpaying for hope? The data gives us all the clues, but it doesn't give us the final answer. And that, right there, is what makes investing so interesting.